Everyone is waiting for the housing crash. Since 2022, headlines have promised a reckoning. Interest rates doubled. Affordability hit a 40-year low. Surely, prices would collapse like they did in 2008. But here's what the headlines missed. The crash already happened. You just can't see it. Home prices today sit near all-time highs. The median existing home sold for $415,000 last month. That's 51% higher than 2019. So where's the crash? It's not in the prices. It's in the silence. This is The Real Estate Historian, where money, power, and shelter collide. And nothing is ever as simple as it looks. To understand how we got here, we need to go back to March 2020. The world was shutting down. The Federal Reserve, fearing economic collapse, slashed interest rates to near zero and began buying billions in mortgage-backed securities every month. Within weeks, 30-year mortgage rates fell below 3% for the first time in American history. What followed was the largest refinancing wave ever recorded. Between 2020 and 2021, American homeowners collectively restructured $4 trillion in mortgage debt. They locked in rates that look like typos: 2.8%, 2.65%. Some borrowers captured loans below 2.5%. They weren't just getting cheaper payments. They were making a bet, whether they knew it or not, that they would never move again. Because what the Fed giveth, the Fed taketh away. By 2023, the same 30-year mortgage rate had climbed past 7%. The cost of borrowing for a home had nearly tripled in 18 months, and suddenly 80% of American mortgage holders found themselves trapped inside their own homes by the best financial decision they ever made. Economists have a name for this. They call it the lock-in effect. I call it golden handcuffs. Either way, it froze the housing market in place. Let's look at what frozen actually means. In a normal housing market, about 4 to 5% of homes change hands every year. That's roughly 40 sales for every 1,000 homes. In 2025, that number has fallen to 27.7 per thousand, a 30% decline from pre-pandemic levels. Transaction volume has dropped to 4.1 million homes per year. That's the lowest figure since 1995. Now here's the paradox. In a normal market, when volume falls, prices follow. Fewer buyers means less competition. Sellers cut prices to attract offers. But that's not what happened. Let me show you why. Consider a homeowner with a $400,000 mortgage at 3%. Their monthly payment is $686. Now imagine they want to move. Same loan amount, new rate 6.5%. Their payment jumps to $2,528. That's an $842 monthly increase, $10,000 a year, for the exact same borrowing power. So they don't move. Multiply that decision by 40 million households, and you have a market where supply has collapsed alongside demand. The people who would sell can't afford to. The people who would buy can't afford to either. It's a standoff disguised as stability. Inventory numbers make it look like things are loosening up. Active listings rose 11% last year to 1.52 million homes. But those aren't new sellers flooding the market. Those are stale listings that can't find buyers. Overpriced homes sitting and waiting. New listings, the actual flow of fresh supply, remain 20% below normal. The market isn't healing, it's calcifying. But here's what nobody tells you. This freeze isn't a bug, it's a feature. Think about what would happen if every locked-in homeowner suddenly decided to sell. 40 million homes would hit the market at once. Prices would collapse 30, 40, maybe 50%. Trillions in home equity would evaporate overnight. Banks holding those mortgages would face cascading losses. The 2008 crisis would look like a warm-up. The system depends on people staying put. And this is where the 2025 market diverges sharply from 2008. In 2008, the crisis was about solvency. Borrowers couldn't pay. Adjustable rate mortgages reset higher, foreclosures spiked. Supply flooded the market while demand collapsed. Prices cratered. In 2025, the crisis is about liquidity. Borrowers can pay, they just can't move. Supply has collapsed because homeowners are financially handcuffed to their 3% mortgages. Demand has collapsed because new buyers face 7% rates. But since supply fell faster than demand, prices haven't budged. The 2008 playbook doesn't apply here. And that's why the market has bifurcated into two completely different realities. In the existing home market, nothing moves. Turnover has dropped 38% from the 2021 peak. Days on market stretch longer. Bidding wars have evaporated. It's a frozen lake. In the new construction market, everything moves. Home builders like Lennar and D.R. Horton have become de facto central banks. They buy down mortgage rates for their buyers, offering 5% financing when the market charges 7%. They're not just selling homes, they're selling payments. Builder incentives now run 8 to 11% of sale price. They've cut their average prices to the low 380,000s. They figured out that in a frozen market, the player who manufactures liquidity wins. So, who wins in a frozen market? Existing homeowners. Their equity remains intact. Their monthly payments stay locked at 2020 levels. They're living in a financial time capsule while inflation erodes everyone else's purchasing power. Home builders. With no competition from resale inventory, they dominate new transactions. They've captured nearly 30% of sales volume, up from a historical norm of 10%. Institutional landlords. Companies like Invitation Homes report 96.5% occupancy and steady rent growth. When people can't buy, they rent. And when they rent, they pay premiums to the institutions that bought 200,000 foreclosed homes after 2008. Now, who loses? First-time buyers face the cruelest math. Record prices and 7% rates simultaneously. The monthly payment on a median home has doubled since 2020. Mortgage originators are bleeding. Volume is dead. Layoffs have gutted the industry. Real estate agents have seen commission pools shrink by a third. And here's the loss no one talks about: labor mobility. The American economy has always depended on workers moving to where the jobs are. Austin, Phoenix, Nashville. But when moving means trading a 3% mortgage for a 7% mortgage, people stay put. They take worse local jobs rather than better distant ones. The lock-in effect doesn't just freeze the housing market, it freezes the labor market too. Everyone's waiting for a housing crash like 2008. But the crash already happened. It just wasn't the crash anyone expected. It's not a crash in prices. It's a crash in movement, in turnover, in the ability of Americans to buy their first home, to move for opportunity, to trade up or downsize. 40 million households are frozen in place by the best mortgages they'll ever get. And as long as rates stay high and those golden handcuffs stay locked, the freeze continues. The market won't crash in the way everyone fears. It will simply calcify, stable on the surface, paralyzed underneath. The American dream isn't dead. It's just not for sale. History has the answers. I'll find them.